Hi, everyone. Welcome to the bank's Monetary Policy Report press conference. We're joined today by Ben Broadbent, Deputy Governor for Monetary Policy, Dave Ramsden, Deputy Governor for Banking and Markets, and the Governor, Andrew Bailey. Andrew will start us off with opening remarks, and then we'll move to questions.
Well, thank you, Katie, and my welcome too. Consumer price inflation fell further to 7.9% in June. That was what we expected to see, and it's good news. And inflation will, we believe, continue to fall over the coming months. That reflects the fact that monetary policy is restrictive. It's working to bring inflation down. Our job is to make absolutely sure that inflation falls all the way back to the 2% target and stays low. So today we've increased bank rate by 0.25 percentage points to 5.25%. Low and stable inflation is the foundation of a healthy economy. High inflation hurts the least well off the most. The projection that we present today is very much in two parts. I'm going to begin with the first part, which is the near-term outlook for inflation over the remainder of this year, before then turning to the second, which is the medium-term outlook and the implications for monetary policy. So starting with the near-term outlook. This chart shows the evolution of consumer price inflation and its components since 2018. It shows that inflation has come off the peak in October last year and that it continues to fall over the rest of this year in our near-term projection. That's the piece shown in the shaded part of the chart. Now, this fall can be attributed in large part to a fall in contribution from energy. Fuel prices have declined and electricity and gas prices have stabilised, albeit at a higher level. The dark orange bars in this chart show how the contribution from energy prices is falling and turning negative, we think, in the coming months. Now, given Ofgem's price cap on electricity and gas bills and the way it slows down the pass-through of wholesale energy prices to consumer bills, we expect inflation to take a further step down in the July data, which will be published in 2 weeks' time. We think that will come down to around 7% at that point, followed by another larger step down in October's data, which will be published in November, to around about 5% on that basis. Now, this more gradual pass-through also substantially helps to explain the difference between current headline inflation in this country and in the euro area, where wholesale energy prices feed through more directly to consumer prices. Where there is more uncertainty is around the time it will take the other non-energy components of the consumer price inflation to come down as well. Price inflation for food and non-alcoholic beverages has been very high, but it does appear to have peaked. And as you can see in this chart, there are signs in the monthly figures that it has started to ease. And evidence collected by the bank's regional agents suggests that a moderation in food input prices is being passed through the supply chain to consumer prices. So we do expect that food price inflation will come down gradually over the rest of this year. And the contribution from food price inflation falls accordingly in our near-term projection from about 2 percentage points today to about 1.25 percentage points towards the end of the year. Similarly, core goods price inflation continues to be broad-based. It's taking time for the fall in energy prices to work through the supply chain, and the prices of imported goods have continued to rise despite a fall in world export prices. And that's why in our central projection, we expect core goods price inflation to come down gradually. But let me be clear, we do expect core goods inflation to ease over the rest of the year, and there are indicators that suggest it could happen faster than in our projection. And as you can see in this chart, output producer price inflation, which measures the change in the price of goods sold by UK manufacturers, has been slowing significantly since its peak in the middle of last year, as indicated by the orange line. Now, that should help to reduce non-energy consumer goods price inflation, which is shown in the blue line, as cost pressures ease in the supply chain. And as the chart shows, that has been the case when producer price inflation has fallen in the past. The final component of inflation is services prices, which is now contributing more to inflation than energy or goods. Now, there has been unwelcome news since May in this area. As you can see in this chart, service price inflation was 7.2% in June, which was higher than we projected in May, and it remains high in our near-term projection for the rest of the year, again, as shown in the shaded part. Now, this upside surprise was primarily driven by some of the more volatile subcomponents of services prices, such as airfares and package holidays, and also vehicle excise duty, which is unrelated to the balance of demand and supply in the economy. So we should not read too much into this surprise for this reason. Nevertheless, since other subcomponents of services price inflation are closely linked to underlying cost pressures in the economy, continued strength in services price inflation may suggest that high inflation could persist for longer. Now, that's what I'm going to say on the short term. Let me now turn to the second part of the story, which is the medium-term outlook. Now, of course, over the medium term, monetary policy has to ensure that inflation returns to target in a timely manner. That's why the Monetary Policy Committee is watching services price inflation very carefully, along with other indicators of inflation persistence. Economic activity has shown some unexpected resilience over recent quarters, but the increases in bank rate that we have implemented weigh to an increasing degree on economic activity. There is evidence that monetary policy is restrictive. So as we look into next year, GDP growth is projected to be weaker than expected in the May monetary policy report, and the balance of demand and supply is shifting in our projection. An increasing degree of economic slack is emerging after the middle of next year. This will help to reduce inflationary pressures in the UK economy. As chart 5 illustrates, in the MPC's projection for consumer price inflation, which is conditioned on the market price for interest rates, inflation is more likely to end the forecast period below the 2% target than above it, albeit slightly. In the modal, or most likely case, inflation is 1.7% in 2 years' time and 1.5% in the third quarter of 2026. However, the committee continues to judge that risks around that central case are skewed towards higher inflation. Adjusting the modal projection for the balance of those risks, the mean or expected path for inflation is close to, albeit just below, the 2% target towards the end of the forecast period. Now, the projection for inflation is broadly similar on the alternative assumption of a constant level of bank rate at 5.25% throughout the forecast period, and that's discussed in the report. And this illustrates that different paths of bank rate can secure a return of inflation to the target. The market curve is higher than the current level of bank rate in the coming quarters, but then falls below it further out, averaging just under 5.5% over the next 3 years. Now, a lot will depend on what happens in the labour market and to pay. There are signs that the labour market is loosening. The unemployment rate rose slightly to 4% in the 3 months to May, and the ratio of vacancies to the number of unemployed job seekers, the so-called VU ratio, an important measure of labour market tightness, has continued to ease, as shown in chart 6. But the labour market remains strong. The VU ratio is still significantly higher than before the pandemic, as you can see in the chart. Annual private sector regular pay growth increased further to 7.7% in the 3 months to May. And this is materially above expectations in the May monetary policy report and notably stronger than standard models of wage growth based on productivity, short-term inflation expectations, and tightness in the labour market would have predicted. So chart 7 gives you a sort of brief sort of insight and sort of line of sight into sort of more of the entrails of the process, if you like, because what this chart shows is a swathe, which you can see in sort of light grey, illustrating the range of forecasts that we derive from the suite of wage models that our staff maintain. And then you can also see in the line the MPC's projection for private sector regular pay growth, wage growth. That line and that projection is our best collective judgment on the committee. And you can see that wage growth is expected to ease more slowly in that line than the models would predict. So what we have here in a nutshell is that the empirical models illustrate what might happen if wage setting will be based on inflation expectations that take account of the downward path of inflation over the near term. But the best collective view of the committee is that we don't have enough evidence at present to be sure that wages will be set in this way. And in our judgment, upside surprises on wage inflation suggest that it will take longer for second round effects to go away than it did for them to appear in response to the sharp rise in prices of many imported goods over 2021-2022. And interacting with a tight labour market, that is expected to have resulted in greater persistence in wage inflation, and with it in the cost pressures that determine price setting in the economy. Now, I also show this chart because the difference between empirical model outputs, and I will put models in the plural here, and the committee's best collective judgment, which is obviously clear here, is, I think, one illustration of the importance of reflecting on how our processes should adapt in a world in which we increasingly face significant uncertainty and large shocks. And so with that in mind, I'm delighted, as we announced recently, that Ben Bernanke has agreed to lead a review into the bank's forecasting and related processes. As you know, Ben is a renowned and award-winning economist with a distinguished career, and I think he's an ideal person to lead this review, which is really, what lessons do we derive from this type of situation, and what do we do going forwards? So let me conclude on today's policy decision. The news to wages and its implications for inflation persistence should be seen within the context of the overall data news since June. Now, as we approach the June meeting, data outturns were strong across indicators of inflation persistence, including service price inflation and employment, as well as wages. The MPC responded to this evidence of more persistent inflation pressure by increasing bank rate by 0.5 percentage points at the June meeting. Since then, while pay growth has come in stronger than expected, other data news has been more mixed in terms of its implications for the persistence of inflationary pressures, and thus the outlook for inflation over the medium term. And that's why the MPC has voted to increase bank rate by 0.25 percentage points today. Now, given the significant increase in bank rate since the start of the tightening cycle, the stance of monetary policy is restrictive in our view. And the evidence is now clear that it is having an impact. To return inflation to target, policy needs to continue to be restrictive, and today we've taken a decision that's consistent with that, which will help to return inflation to its target. I'm not going to judge what the path of rates will be, not least because, as the report indicates, more than one path may deliver inflation back to target sustainably. We've taken a decision today based on the evidence we have, and we will go on judging what is most appropriate based on the evidence we receive. The MPC will continue to monitor closely indications of persistent inflationary pressures and resilience in the economy as a whole, including the tightness of labour market conditions and the behaviour of wage growth and service price inflation. If there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. And we will ensure that bank rate is sufficiently restrictive for sufficiently long to return inflation to the 2% target sustainably in the medium term, in line with the remit. So with that, Ben, Dave and I will be happy to take your questions. Thank you.
When you get a hold of the microphone, please let us know what your name is, where you're from, and if we could limit it to one question each so we can get around to everyone, that would be great. We'll start with Ed, and then we'll go to Sue, please.
Thank you, Governor. Actually, so some of your final words there, you were talking about, you were kind of echoing something that was in the minutes about having rates sufficiently high for sufficiently long to bring inflation back to target. I just wonder, can you expand on that a little bit? Because there are many households out there, they're looking at interest rates, they're hoping that after they were high for a while that they would start to come down. Are you saying that actually we need to be prepared for interest rates to be high for longer than a lot of people might be expecting right now?
Well, let me start. I'm sure Ben will want to come in. it's worth starting, I think, with the market curve, because, of course, the market curve does have a fall in interest rates in them, but it goes higher before that happens. And I made the point in the opening remarks about what that delivers as an average rate over time. Now, there are many potential paths, but we have also shown, as we always do, but I would draw attention to it, what happens if you do the constant rate. So you assume it's constant at today's rate, which is another potential path. And that delivers, again, a return to target. So the point I would make is that we have to balance the risks here. We've got risks both ways, I think. There are inflation risks, certainly on the upside, which we've reflected in the mean projection. I would highlight, and Ben may want to come on to this point, that relative to May, more of the risk that we saw in May we think has crystallized and is in the modal projection, but we still have a mean projection. It's just a smaller mean projection than we had in May. But we're also, of course, conscious that the projection for activity has weakened because the curve is higher than it was in May, and we will have to bear those, that path and that risk in mind as well. Ben, do you want to?
No, I think that's very well said. As Andrew says, there may be different paths that achieve the same end. Just one particular point, there was a lot of focus in May on mortgage costs. Those mortgage costs respond much more these days, given the shift in maturities, to 2 or 3 year interest rates than they do to the overnight rate and the bank rate. And that's one illustration of how there might be lots of paths that keep that 2 year rate roughly stable. And you talked about what people expect. At least 10 seconds before we came up here, we had a look at the reaction of the market curve and specifically of 2 year interest rates to today's decision. And they moved very, very little. Immediately before and after the decision, I think they were down 3 basis points. So I don't think that this has had a tremendous effect, either what we've done or that point, which I think was well worth making, has had a tremendous decision on that 2 year interest rate, or therefore the equivalent, say, quoted mortgage rates, or indeed 2 or 3 year interest rates facing businesses, which also matter.
And if I could just add one final point, where we go, which path we end up being on, as Andrew stressed at the end of his remarks, will depend on the evidence and on the evidence of persistence. That's what's driving the decisions.
Hi, Governor. Sue Chan from The Telegraph. A lot of the upgrades that you've made to your inflation forecasts in the latter part are to do with the MPC recognising that some of the risks to inflation that you've warned about in previous forecasts are in fact starting to happen. Why are you only fully starting to recognise these risks now, given these pressures have been there for months? And I was really interested in that wage growth chart and your judgment that it will remain more stubborn. Is that the first time you've moved so markedly away from traditional modelling and models?
Well, actually, so if I don't have them with me, but if I showed you the chart, the same chart for last time, the line would have been sort of near the top of the swathe, and we've been near the top of the swathe for quite a while, actually. So there is a move, and as you can see, obviously that move reflects the evidence we've had since May in terms of the outturns. I just come back to emphasise the points I made in the remarks, actually, because I think this is a really important point. And it's what links the first half to the second half of the sort of these two parts. If the fall in inflation that we think now is going to happen, we think with more confidence is going to happen this year, translates into inflation expectations, and if those inflation expectations translate into wage bargaining, then I think you will see there is a possibility, or a risk as we would say, but a possibility that line will actually go down and go nearer to the swathe, because the swathe puts a greater weight, for instance, on inflation expectations. The question that in our mind, as I said, is what confidence do we have of that happening? Well, to answer your question, your question sense of saying why only now we've seen evidence, I think, in the last couple of months that that element of the labour market, the other parts of the labour market I think are softening, but that pay element of the labour market hasn't. That's the point I would draw out. So you can see from that, in a sense, that although I would never want in these events to say there's only one indicator that matters, because that's not true. Obviously, it is an important point in judging the future path.
If I can just add one point to that, I mean, you draw attention to this use of the word, risk crystallizing. That's the first time we've used that word in this context, but the risks on persistence have been crystallizing prior, through this year. That's why we've been having to raise rates in response to increasing evidence of persistence. So it's not suddenly that evidence has appeared. We've been seeing that evidence for some time, which is why we're having to keep raising rates.
Can we go to Faisal and then Halia, please?
Hello, Faisal Islam, BBC News. Just can you explain why you've used that new language on bank rate being sufficiently restrictive for sufficiently long? Are you concerned that households may have become a bit accustomed to zero rates over 15 years and may expect rates that 5% is the aberration, and may expect them to fall if inflation falls back to target, and that's not going to happen? And does it also implicitly suggest that rates are very close to peak, that you're having to make this statement now?
Well, Ben, I'm sure I want to comment on that. Let me start. I think let's start with where the word restrictive, in a sense, first gets used, which is to describe the stance of policy as of now and how we think policy is working through. And the policy, as I think I said earlier, is having an effect. And I think that's the important starting point for this. You'll be aware that obviously both the Federal Reserve and the ECB have used the word restrictive, and we've used the word restrictive, not because we love to sort of use the same words, but because actually I think it's a reasonable description of where we all are at the moment in terms of the way monetary policy is working. And of course, given the lags in the effects of monetary policy, it's not necessarily surprising that it's taken some time for this evidence to come through, but we now think it is coming through and we see it. So that's the starting point. And then I think that you're right to say that the comment at the end is to say, in order to get inflation back to target, we are going to have to, in a sense, keep this stance of policy. But I want to just emphasize again, and I'll hand over to Ben, that this stance can incorporate quite a lot of different paths of interest rates. I think that's a very important point to make.
It's not quite true to say that the forecast depends, and the forecast outcomes for inflation at 2 or 3 years depend on the average level of interest rates until then. But it's closer to the truth than it is to say they depend on the interest rate only today. As I was talking with Ed, for example, that 2 or 3 year interest rate, market interest rate, is more important than it was as a driver of private sector interest rates, for example. We have to make sure inflation comes down sustainably to target, and therefore we have to be focused on making sure that average interest rate, given the information we have right now, is sufficient to ensure that happens. Now that can change. It's not as if we're fixing the entire path of interest rates forever today, and I can't say exactly where the peak will be, we don't know. But our focus is very much on the medium term, and we have to ensure that interest rates over that period are sufficiently restrictive. So I don't think we're saying any more than that. We didn't have in mind somehow that households in particular were underestimating the risks. Households right now and have been facing 2 year interest rates, have for some time been facing 2 year interest rates that are markedly higher than they have been for decades, frankly. So I don't think that was our particular reason for saying this.
Channel 4 News. Good afternoon, Governor. You talked about there being some good news at the beginning of your opening statement, but we've got slower growth, higher unemployment, higher bank rate. Inflation looks more challenging. It sounds like the wage price spiral looks like it's crystallizing. What's gone wrong with the economy, and has the bank lost control?
Well, I wouldn't agree with that, Helen. I mean, to start with, the good news is that, I said it a few minutes ago, that I think the path of inflation in the first half is now much more assured. The number that we saw a couple of weeks ago, to be frank, was a number that we had thought would happen. I showed you earlier that chart, which, for instance, on goods prices, which compared producer prices to consumer prices. And as you can see in that chart, there's a major puzzle in that chart, a really major puzzle as to why you've had this, dislocation between consumer and producer prices. And it's been puzzling us. We'd really had thought that we would start to see, evidence of that fall sooner, but we have seen it now. Now, of course, you can never put too much weight on just one number, but I think, it's not an aberration as a number. So I think it is a sign that inflation is coming down. As I said in the opening remarks, because of the way the UK energy policies work, there are two quite substantial base effects to come, and those base effects are annual effects. And there would have to be a massive change in energy prices to take those away now. So there is, I think, a much more assured path downwards of inflation, and that's a good thing. As far as the second half of the forecast, where obviously, as I said, policy and judgment in terms of how policy will work and how we should set it comes in. I mean, let me sort of give a bit of a counter view. The economy has been much more resilient. Now, that's good news. I mean, that is good news. We have to then set policy to, in a sense, work with it. But the fact that, for instance, we were sitting here, back last November saying we thought there was going to be a long but shallow recession. A lot of that was based on energy prices at the time, which obviously you remember were much higher. That has not transpired. We've had a much different and more resilient picture on economic activity. Yes, we have seen some increase in unemployment, but unemployment remains historically very low. That's a good thing. So I think we all want to see that. So I would give you the counter view and push back. There are there are arguments that you can definitely put the other way.
Go to Jemana and then Joel, please.
Thank you, Governor. In the run-up to the June 50 basis point hike, we saw two upward surprises in CPI. Going into today's decision, we had one downward surprise in the CPI figures. I have a question about your reaction function going forwards. Are you likely to place more emphasis on where inflation numbers come in relative to your own expectations? Or are you watching the evolution of domestic inflationary pressures, things like services, service price inflation, wage pressures, more than where the headline number comes in relative to your expectations?
Well, I think my first answer would be all of the above, probably, to that question, because I don't think the way you set it up, it's sort of in conflict. I mean, I think what we always have to do is that we have to look at the news and, of course, then judge how the news, in a sense, sits against where we thought things would go to. And as I said, I think just to put that into context, as you rightly say, we had some quite large evidence in June, which was quite clearly at odds with the view we took in May. Today, I would say we've seen, one thing sort of correct itself and one thing not correct itself in a way. That's the way to sum it up. So the one thing that has corrected itself is actually headline inflation, because in fact, headline inflation on the latest number is pretty much exactly where we thought it would be in the May forecast. The components, though, are not quite the same. The thing that hasn't corrected itself, coming back to some of the earlier discussion, is pay and the labour market particularly. And you see some of that also in services prices, although I did make that caveat that there's a sort of there's what looks like a possibly non-persistent bit of services, and then there's a persistent bit of services, and you've got some of both in there. So I think putting all of that into context, we had some unpleasant surprises in June. We've seen some of that turn around, which is frankly you can put into context today why I don't think the case for speaking personally now, I don't think that was a case for a 50 basis point raise today. But we have still got this very clear risk out there, which I think is well summed up by some of the charts. So so I don't think your question is really at odds in that sense. I think both things have to come into play.
And if I could just add, Andrew, on that, I thought your presentation brought out that difference between our focus in the presentation for the remainder of this year is on those short-term forecasts where we publish a lot of detail, including on the components of inflation as well as on wages. And so when it comes to our reaction function, we can track those three indicators that we've highlighted: services inflation, labour market tightness, and the third metric, private sector regular wages, against those short-term developments. That's what we were doing in May. That's why June the majority went for a 50 basis point increase. As Andrew says, for August, the majority has gone for a 25 basis point increase. But that we have that detail for how inflation we think will evolve over the coming few months and the components in that. And as Andrew says, there is more confidence about that than further out.
Thanks very much. Joel Hills, ITV News. I want to go back to the language and the sort of messaging. Last week at the European Central Bank press conference, Christine Lagarde was asked about with her interest rates. She said, do we have more ground to cover? At this point in time, I wouldn't say so. There is the possibility of a hike next time. There's the possibility of a pause. She is very clearly suggesting that interest rates may be peaking. Are you suggesting they are here in the UK, Governor?
Well,
and also, can I ask, if policy rate now is restrictive, where is it neutral?
Well, I'll take the first part. Might hand over to Ben then. I think you'll see from the language we've used that we've emphasised that we remain evidence-driven, and I think that's important. I'm not sure the ECB would necessarily disagree on that point, but I think it is important to be evidence-driven. I think go back to the last question for a moment. As you know, as you can see, we've had evidence. We've had quite contrasting evidence in the last couple of months or so. The evidence has gone one way, then gone a bit the other way. So I don't think it is time to sort of declare it's all over and we're sort of sticking where we are for the moment, because I think that really does sit at odds with the fact that we've had some very big pieces of news. And that they are, they're not going in the same direction. So I think we have to remain evidence-driven. We've continued to use language which I know used before, which is to say, if we get more evidence of more persistent inflation, then we will have to react to that. But I'd finish this point by just emphasising the fact that also there is no presumed path of interest rates from here. And I said in the opening remarks again, and I'll emphasise again, there is more than one path from here that delivers us back to the target.
Yeah, just on the, I'll quote you if I remember it. Something from a quotation from another paper by John Williams, the US economist, who wrote a well-known paper about the neutral rate of interest, tried to estimate it some years ago. Lots of these sort of estimates have been made. And he quoted his namesake from a long time ago. There was a Welshman who was an economist at Harvard in the 30s, who liked conceptually the idea of a neutral interest rate, but was skeptical that it could be of much practical use, because it was very difficult in real time to say precisely what it was. He said, only after the event, once you've seen the response of the economy, can you say where you think it might have been. So he said, it's like faith, was the quote, it's seen by its works. And I have some sympathy for that view. So we have not given a precise number, and even if you look at that Laubach-Williams paper, I think the error bands around that estimate were, several hundred basis points. What we can say is we think we're seeing evidence that the rate of interest is above the neutral rate, without saying precisely what that is, because we're beginning to see an effect on demand. That's what we're prepared to say. I'm not going to give you some precise number, because I don't know precisely what it is, and I don't think it's possible to be precise. But we think we're seeing a sign that it's weighing now on demand growth. Unemployment has gone up slightly. The VU ratio, as the governor said, has come down. These are signs that policy is restrictive, by which we mean simply that right now the interest rate is probably above our star. But beyond that, we're not going to give you a precise estimate.
In 2018, August 2018, the bank's assessment, I think, was that it was around 2.25%. Is that view changed, or is that still?
No, look, that was a long run estimate. And so there's a difference between what we call sort of long run R star and short run R star, which may depend on other factors affecting demand. B, look at the error bars around that number. They were very, very significant. So I will not give you a precise estimate, A, because it can change, and B, because it would be misleading, it would convey that the estimate is more precise than it really can be.
Can we go to Larry and then Delphine, please?
Larry Elliott of The Guardian. Isn't the language that monetary policy will remain restrictive for long enough to bring inflation down, isn't that just a new way of saying if it isn't hurting, it isn't, if it isn't hurting, it isn't working? And isn't your real message out to people that a certain amount of pain is inevitable from this monetary tightening, and the degree to which it's of pain is going to be affected by the willingness of pay bargainers to take a real pay cut in the months to come?
Well, I think, Larry, I'd draw back to the answer to Hila's question, actually, which I think it's a sort of, in a sense, variant to that question. I would not use words like pain because, as I said, the economy is more resilient, and we've had to respond to that, but there is a good news element to that. Now, we do recognise, and I think it's very important, of course, to say that this is, inflation has a very serious effect, and it has a very serious effect, also particularly on those who are least well off, and particularly, as I've said a number of times before, the sort of the makeup of inflation that we've been experiencing because of its concentration in sort of the essentials of life, energy and food. So that's important. But I would emphasise this point that the economy is more resilient, and that's a good thing. I mean, yes, unemployment's gone up a bit, but it is still at historically low levels, and that's good, obviously. Growth in the economy has been more resilient than we thought it would be. We both haven't experienced a recession, and we're not forecasting one. And so there are important elements to that. So I would put the word restrictive into that context. Of course, we hope that we can deliver the path that we've set out in the report, because the path that we've set out in the report does not have a recession in it. We will have to see. But I really would emphasise that point. Yes, of course, we understand that monetary policy has an effect. But, and I'll just finish with another thing I've said many times before, that if we don't bring inflation down, the effects are worse.
Just very quickly, I quite agree with everything Andrew just said. There has been one of the reasons for the resilience is actually that, contrary to what you said, real incomes are growing now. The big picture story of the last couple of years is the economy got hit with these enormous, almighty rises in import prices. That was an unavoidable hit to real national income. That has been extremely painful already. Those are now subsiding, actually. And import prices, as Andrew said, haven't fallen back everywhere. Some have. Most obviously energy, but some other imported goods prices. And that is, for that reason, real incomes are now actually growing. And if well, hang on, sequentially I'm talking about. So it seems to me likely, this is certainly our assessment right now, in the third quarter, real labour income will be higher than in the second quarter. You're talking about year-on-year growth up to May. So growth from last May to this May, that's what we've got on nominal wage growth. I'm talking about right now. Real incomes are growing. Our assessment is that in this calendar year, real labour income will be higher than last year, and the same will be true next year. So it's not true to say that real wage growth is, that wage bargains have to be negative. Our forecast, as it happens for the end of the year, even in annual space for the fourth quarter, is that average earnings growth will be above inflation.
Just to reinforce that, I mean, and we set this out, Larry, on page 54, we've got full quarter growth in real household income to average 1.4% for the rest of this year. And we've got that real income growth is materially higher than was projected back in November 2022, when, as Andrew was saying, we and many others were expecting to see a recession. So the picture, this is kind of what is underpinning the resilience that we've seen in the economy. One of the key drivers. Obviously, there are other factors going on. There have been fiscal interventions, but that's why we emphasise this resilience so much.
Go ahead, Delphine.
Thanks. So you've set out in quite a lot of detail in the report various ways in which the forecasts are more than usually a judgment call. And it seems there are various areas where the MPC just doesn't believe the numbers that come out of the modelling. Is the bank's forecasting process broken? And can you talk in a bit more detail about what you'd like the Bernanke review to address?
Well, let me start. You're right in the sense of, there are always judgments that we have to make. So going back to the chart I showed, even if we were inside the swathe, as you can see, the swathe is actually, reasonably broad. So we're always going to have to make judgments about where we are. But the unusual thing, it's not unique, but it's unusual, is that we're outside it, and therefore we're having to make judgments. And of course, that can have other consequences about how bits of the overall forecast fit together. But what I would come back to is, so for me, this is not about saying, well, the models are broken in some sense of how could this possibly happen? They must be perfect, because obviously they're not. But the fact that we've had, and Ben was mentioning a few minutes ago, just such very, very big shocks in the world economy. These models are not built with we don't have a run of history that has those sorts of shocks. It doesn't have, a global pandemic. It doesn't have a war in Europe. In the historical data to draw upon. So it's not in a way surprising that these things have come up, that these models have been put under such strain. So it's not the fault of the modelling process. The reason I think it's so important to have the review is to say, who knows what's going to happen in the future? there are all sorts of predictions you can read out there. I'm not going to add to those predictions today about future shocks in the world. But I think there are a lot of lessons we hopefully can draw about how do you, in a sense, approach policy making in a situation where you're having such big shocks are hitting the economy. And that's, for me, is what I hope we will get a lot of value from. Not because I think, well, we obviously should have avoided this situation. I'm not sure that's possible because of the size of the shocks and the way the models are created. But how do you make policy? How do you use models? How do you use forecasts in a world where that sort of thing is happening?
Yeah, that's absolutely right. And for my part, I don't think there's any model that could have been estimated, certainly over the inflation targeting period. And for other reasons, one tends to limit oneself to a given monetary policy regime when you estimate these relationships, that could have dealt with what we've had in the last couple of years. There's not a question of the models being wrong. It's a question of the sample period and the unprecedented nature of the shocks we've had. And the review is really about that and about the relationship between forecasts and policy in that environment. That's what it's about.
And the only thing,
and by the way, if you go back, there's a box in the report about the forecasts for inflation. We happen to be above significantly in February 22, the consensus forecast for inflation right now. That doesn't mean these models or the other forecasters were wrong. It's simply a reflection of the scale of the shocks we've had and the ability of models to deal with them. Yes, it's always been the case that this is my, what did I say? I can't even remember now. 49th forecast round, I think. There are always judgments. The forecasts are rightly described as the best collective judgment of the committee. They're not mechanical model produced. The models are a guide, and as Andrew said at the beginning, it's models plural. Those near-term models of wage growth, it's not just one of them. But it's always the case that the forecasts the committee publishes are the best collective judgment of the committee. And we spend a long time going through them. And if it was simply that we pressed a button and a model churned out some number, we wouldn't have to spend those hours. So I don't think it's a matter of degree. as to the extent to which you put the weight on the model. And we've had to, the weight on our own judgment has inevitably grown through this period. That's true.
And just to add to that, I mean, that's true. I mean, I haven't been involved in as many forecast rounds here in this role, but when I was at the Treasury working with the OBR on their forecasts, OECD forecasts, IMF, none of them are mechanical. They've all got judgment in them, and it's the question of the degree of judgment, the type of models you use, the range of models, how you interpret those, informing your forecast judgments.
Let's go to Ben and then Dave, please.
Ben Martin from The Times. I just wonder, given the structure of the mortgage market has changed since previous tightening cycles, and so it means there's more of a lag, are savings rates now proving to be more important to monetary policy than perhaps you thought a year ago? And secondly, on the same issue, are you happy? Are you seeing signs that commercial banks, high street lenders, are now raising saving rates to levels that you think are fairer for consumers and will actually help with your bring down inflation?
Yeah, well, I might take the second part. Ben or Dave may want to come in as well. I'll start with the second part because it's a good question. We'll come back to the first part. So as a matter of fact, actually, interestingly, our most recent numbers suggest that in June and following our June rise, the pass-through to sight deposits, let me draw an important distinction between sight deposits and term deposits, because the pass-through to term deposits has throughout been much faster, but it's sight deposits that have attracted, obviously, all the attention, quite rightly. So actually, interestingly, the latest numbers we have in June suggest that the pass-through of our June interest rate rise, the 50 basis points to sight deposits, has been pretty full, actually. So that's a change, because it certainly was not full, as has been well covered, obviously, in a lot of coverage. It was not that was not the case previously. The other thing I would say is that I think just go back to something I think I said at the Financial Stability Report press conference a few weeks ago. It's very important that we have, and I think we demonstrated there in the stress test, we have a banking system that is resilient, and therefore financial stability is not an impediment to passing through interest rates in that sense. Banks are not having to make decisions, in my view, based on their concerns about financial stability. That's not the case at all. So that's important. That creates, in a sense, the preconditions. The final thing I'd say is that I think the initiative that the FCA has taken is very important, because I've said before that I think competition is very important in this sense. There should be competition for deposits. The public should feel that it can actually shop around for deposits and the rates it receives. And I think the measures the FCA has announced, particularly on transparency, is important in that respect, to give the public what they deserve, which is a much better line of sight of what they can get for their money. So I think that's important. So I think, to sum up on that point, the latest news is encouraging that that we seem to be seeing a change, but I don't think we can regard it as done at this point by any means. Come back to your points on mortgage rates. On mortgage rates and saving rates. I mean, I think it's clearly important, obviously, that we, as you say, the mortgage market has changed. That does affect the monetary transmission mechanism. We have to make that judgment every time we make a decision on rates as to how the transmission mechanism is working through. And we know it's slower now because of the shift to fixed rate mortgage markets. And then we have to also balance the fact that there is, as you say, there's an effect in this part of the transmission mechanism. Bear in mind, this is only one part of the transmission mechanism. There's an effect that comes through via mortgage rates, and then there's an effect that comes through via saving rates. They're different, of course, because the behaviour of savers and the behaviour of borrowers is different in that sense.
Well, I mean, even if you add those up, those two are only a minority of the transmission of policy. And on average, through the cycle, our guess is that the mortgage channel is probably, not a guess or estimate, barely a quarter of the total effect on other asset prices, effect on housing investment, effect on business investment. So there's a lot overall through which monetary policy works. Catherine Mann gave a good speech about this a while ago. There's a bit in the middle of the report here about these various channels, more significant even often than the effect on consumption of mortgage rates, the effect on housing investment, on business investment, so forth. We've not seen as much until recently through this cycle as one other channel that often matters, which is the exchange rate, but that too has started to move now. So there was a lot of focus in May on this mortgage cash flow stuff, and that matters, but I think it's important to keep it in perspective.
Thank you, David Robbins from Market News. Just on that point, the old ready reckoner was it took 18 to 24 months for full effects of an interest rate hike or change to come through. Should we think it's now shortened, gone longer? How confident are you? Is it a divisive point on the MPC? What would you suggest as a ready reckoner now?
I don't think our view has changed overall. I mean, there are times when, there are certain shocks which take longer to pass through. But in terms of the marginal effect of policy, that sort of 2-year point and beyond is, there's a reason we get focused on that when we discuss what has motivated policy changes, which is that's still roughly our view of, when you're getting to the peak effects of today's interest rate decisions. So although there are bits that may have got longer, including this mortgage cash flow, I think in terms of the overall effect, I don't think we've made a material change, and it's not something over which the committee has argued or debated or disagreed much.
Can we go to Francine and then Jessie, please?
Thank you so much. Governor Francine Lacqua, Bloomberg TV. Governor, how soon, or what's the soonest you think the bank could actually cut interest rates?
Well, I'm not going to make a prediction on that. As I said earlier, we've taken a decision today based on the sort of the facts as we see them today and the evidence we have. We think it's the right decision to take today. As I said, I think there are a number of paths from here. I mean, there's always a number of paths from here, you could rightly say to me, but I think it is important to stress that point. But I wouldn't want to at all speculate. It's far too soon to speculate on when we might see a cut. No, I think that falls into the nice try category.
Hello, Jessie Hewitson at the newspaper. So what would it be that you would need to see or feel confident of in order to pause rates or bring them down?
Well, again, I think let me just lay out the evidence that we've looked at. And as I said, we've got I think a short-run profile of inflation that we're increasingly sort of confident, because the short run eventually becomes today. And I think it is the piece of news we had a couple of weeks ago, begins to firm that up. But what we're really focused on, and if you sit in the discussions of the committee, the second half is the thing that takes up all the time, because it's the much more sort of judgmental and behavioural part of the forecast. And I think I have to come back to this point that there are a number of elements there that are the source of risks to the upside. Highlight obviously services inflation, the labour market, and particularly the wage element of the labour market. Don't go through all the evidence again. Services, yes, it's been on the upside. Question mark about just how persistent some of that is, but we'll see. The non-wage elements of the labour market, we are beginning to see softening, and by the way, our regional agents are supporting that. They've come back. When Dave and Ben and others go out on visits, we are picking that story up. Signs of softening. You see it in the VU ratio, as we said earlier. Pay, I'm afraid we haven't yet seen that.
We'll go Jack and Jack.
Hi there, Jack Varnick from Citi. This probably speaks back to the growth point there and the rate cuts as well. I think if you look in the forecasts, going in towards the end of next year, growth is very, very close to going into recessionary territory, but inflation is still just about above target. Does that mean there's almost less room for the bank to cut interest rates at that point? And then probably over the longer term, obviously you've spoken previously about the weakness in the supply side of the economy. Is the economy almost less capable of absorbing lower interest rates without developing higher inflation?
Well, the weakness of the supply side of the economy is something we've talked about quite a lot over time, and I wouldn't particularly change view on that. By the way, the next time we gather here in November, we'll have done our annual supply side review, so we'll probably have something to say about that next time to see what we come up with. But you're right. We have got a potential growth rate that is considerably below, certainly what I've experienced throughout much of my career. I think all of us would probably say that. And you're right. That's relevant. On the weakness of growth points, I mean, the thing that has really changed the forecast in this respect, of course, is that the curve has moved upwards since last time. That's the thing that has really moved it. Dave, did you want to come in on that?
Well, only to say that, I mean, obviously there are, as Andrew stressed, in that second part of the forecast, we're much more into judgment territory. But on the demand side of the economy, it is the movement up in the curve where we're now, over the 3 years of the forecast, I think we've now got bank rate averaging in the market implied curve about 5.5% compared to 4% back in the May forecast. That is really weighing on demand. Currently, as we've said, we've had more resilience on the demand side. We're seeing growth at the moment, underlying growth of around 0.25% a quarter. We do think that into next year, as Andrew stressed, that will slow to much closer to really the economy not really growing through next year. I think it grows a little bit in annual average terms. So that is the impact of tighter financial conditions, both from the market implied curve, but also the exchange rate being rather stronger in this forecast.
Jack Denton from Barron's Magazine. Governor Bailey, do you believe that you've got rates right, or have you made a mistake? With an economic slowdown on the horizon, inflation still unbearably high, should the UK have embraced slowdown, even recession, earlier in order to bring inflation down faster?
Well, I've said before in these, I think we have to be very careful about, if you don't mind me saying so, hindsight judgments. We don't set policy with the benefit of hindsight. We set policy, as we have done today, with the facts as we see them at the time. And we've always done that, and I think we've always based our assessment at the time on the best evidence and the best judgment we can have. So I'm afraid I don't agree with that assumption. I would also say that given the nature of these very big supply shocks that we've had, if you run these sorts of tests or simulations, call them what you like, and I think, Ben, you made a speech on this, and I think Silvana Tenera, who's recently left the committee, made a speech on that, and say, what would you have had to do to monetary policy? Had you known that this was going to happen, what would you have had to do to offset it and to therefore maintain its inflationary target? And I'm afraid the answers are sort of, slightly eye-popping, frankly, in terms of what they come up with. So, but we didn't know that. I mean, we didn't know that Russia was going to invade Ukraine. Obviously, that's, I'm afraid, not something any of us knew. But I would just caution that the important point is we don't have hindsight. And I would just add, these are huge shocks that we have to deal with. Just coming back to Delphine's question on models. The question is, how do you deal with these shocks, and how do you set policy into shocks? It does raise some very important lessons learned, but I do not think they suggest you got monetary policy fundamentally wrong. What it does suggest is there are always, and I think this is the right thing to say for any policy-making institution, lessons that we can learn from the experience.
Tom and Deirdre.
Hi, Tom Rees from Bloomberg. If rates need to stay higher for much longer, as you suggest in the guidance today, is that likely to prolong and worsen the downturn we're starting to see in the housing market? And what signs would you need to see to get out of restrictive territory?
Well, I'll start with the first one. I might want to come in. On the housing market, I think what I would say is, yes, we are seeing, of course, some adjustment in the housing market. But let me just say, I mean, the evidence, it needs to be all of the evidence needs to be taken into consideration. So yes, we've seen, some decline in house prices. On the other hand, the latest numbers suggest that we had in earlier this week suggests that there was a small increase in net lending on the latest numbers and a small increase in mortgage approvals. And that will take some months to come through because there's a lag of some months between approvals and actual lending. So I think the evidence on the housing market is, yes, there's an adjustment. Of course, I don't think that we should be surprised at that, but I would certainly not wish to talk this up into a crisis in the housing market, because I think there's plenty of evidence that suggests that this is a process that has some moderating influences in it as well, and the data suggests that.
No, I mean, in general, on the interest rate, we spent all of today, and this is the main purpose of today, explaining the decision we're taking today. It's about the outlook for the future, and clearly future interest rates will depend on that similar judgment in advance. And we're not going to make predictions about what the outlook with them. We had a question earlier about what might happen to interest rates at the end of next year. Well, I can tell you the end of next year, the interest rates will depend on what the outlook is for inflation in 2028. And we're not making that judgment right now. Clearly in this report, I hope it's clear, and I hope it's been clear in what the MPC has said, that we're focused on things that we think tell us about medium-term inflationary pressure. And the interest rate will in future continue to depend on those things. The best judgment we have now is that the stance of policy, certainly embedded in the market curve or even the constant interest rate, these are the kind of alternatives that one can use, bring you back to target on the mean forecast, which I think is what really matters, in a sustainable fashion. But future interest rates will depend on future news, which we're not getting into now.
The BBC. Just on food price inflation, it is expected to ease later this year. But I just wondered, do you think that Russia's withdrawal from the grain deal with Ukraine, will that have any impact on UK food prices this year?
Well, it's a good question. So just to sort of set the scene, I think we've all spent, and I've certainly spent a lot of time sort of visiting and talking to food producers and food retailers in recent months. It's so important. And I think if I draw out the message that I draw out a sort of single message from it, it is food price inflation is declining and it's going to go on declining. It's taken longer than I think anybody expected. And that includes, I think, many people involved in the food industry. I think the reasons for that are, in the light of sort of everything that's happened, easier now to, in a sense, discern. I think I get two messages come through quite consistently. One is actually the energy contribution to. It's quite interesting actually that food production has quite a high energy component in it. And so energy costs are important, but energy costs are now coming off. But business energy costs have got somewhat different pattern to household energy costs. The second thing that many, particularly farmers, have told me is that they, because of the sheer uncertainty about access to raw inputs, as it were, last year they bought forward for longer and therefore locked in higher prices for longer, out of a concern. I mean, it's something like fertilizer, which Russia is a major producer of. Out of a concern about getting access to it, they bought forward for longer, and so that's locked in higher prices for longer. And I think that's one of the other things that's helping to explain this slower pass-through. But the consistent message is, and we see it in the data now, that it is coming off, but it's coming off later and more slowly, I think, than we thought. On the Russia Black Sea point that you make, I think it's something we have to watch carefully. I mean, certainly it has had an effect on wheat prices, but I think that so far, I would say people are saying, not as much as probably initially last year. But I think we just have to keep watching this, because I think going back to some of the other questions, it's these shocks that we are now having to sort of, in a sense, get accustomed to dealing with, in a sense, because we are seeing more of them. So we do have to watch it very carefully, yeah.
And just on that, I mean, through our agents network, we're always talking to the food industry. But in the last couple of months, we've intensified our engagement. So, you'll find it's on page 75. We've got a 3-page box about key messages from our meetings on food price inflation, which goes into a lot more colour, a lot more granularity to sort of underpin what Andrew was just saying, to help us understand why there's been slower pass-through, greater persistence in food inflation. So would encourage you to have a look at that.
I'm very grateful to everyone in the food industry who's certainly taken the time to explain it to me, which is it's incredibly helpful, frankly.
We'll take one last question from Jeff.
Sorry for being in the most awkward part of the room. Thank you, Katie. This is a question for Mr. Ramsden, really. You said in your recent speech that QT was rolling off in the background nice and calmly. For the last couple of days, the long end of the bond market has come very much into the foreground. And there's a sense in the bond market, particularly with the downgrade of the US, that something structural may have changed. It's maybe one of the shocks that we're going to have to get accustomed to as well, perhaps. So I appreciate you didn't have to make the decision today, but did you talk about the pace of QT over the next 12 months at today's meeting? And are you really going to accelerate the pace if the situation in the US is as unsettled as it is currently in a month's time?
Well, thanks very much for the question. Let me answer it in 2 parts. I mean, in today's monetary policy report, we have quite a large section setting out. It's from page 27, setting out the analysis that staff have done on the first year of QT. Last September, the MPC voted to reduce the stock of gilts by 80 billion over the following year. So there's a box in the MPR which really repeats a lot of information that I put out in a speech I gave back in July. It's really important to stress that the MPC will make a decision on the pace for reduction in the stock of gilts at the September meeting. So we've got the analysis out there today. As I said in my speech back in July, personally, I can see a case for slightly increasing that pace from the 80 billion, but the MPC has not made a collective decision. I'll make that in September. You've highlighted, the second part, in the last few days, we have seen some movements in the long end of global bond markets. We've obviously had what the Bank of Japan has done today with its second intervention in recent days, given its new, more flexible policy on yield curve control. We are seeing markets react, as they always do, to developments, including from the US. So we are conscious of those developments, and as we always do, we're monitoring markets very closely. But I'm not going to try and, I wouldn't want to suggest that, I wouldn't put the kind of interpretation on those developments of the sort that you did, that there's some huge structural change. I think we're seeing more reactions to either financial developments or other announcements rather than something more significant. Anyway, the MPC will get updated briefing in September in order to inform its decision.